So now we've talked about deferrals, depreciation. Now we're going to talk about accruals. There are two types of accruals, accrued expenses and accrued revenues. Accrued expenses is where we record expense before paying cash. Examples of accrued expenses that you will see are salaries, interest, and income taxes. Since accrued expenses are incurred before we pay cash for the expenses, it results in a liability for the company. Let's take a look at an example next. Let's take a look at this example, which says that workers are paid $1,000 per week every Friday. So this is the month of December for 2013, and the workers are paid $1,000 every Friday. The weekly salary is for 5 days, Monday through Friday. They want to know what are the accrued expenses for 2013. Since the workers get paid every Friday, they would have gotten paid on the 6th, the 13th, the 20th, and the 27th of December. The next pay date would be the 3rd of January. 1st, 2nd, 3rd of January of 2014. Our accounting year end falls on the 31st of December. So we've got 2 days that fall in that last pay period, 2 days that fall for 2013, and 3 days for 2014. The matching concept says that we need to measure all expenses incurred in the period. And the 30th and the 31st, the salaries for those 2 days should be recorded for 2013. We need to measure it and record those expenses. So the first step would be to calculate how much are the salaries for the 30th and the 31st of December. You know that the workers get paid $1,000 for 5 days, which means each day they receive $200. We need to take into account 2 days, so for those 2 days, the salaries are $400. So for the week of January 3rd, 2014, whatever they get paid, $400 of that will be for 2013, and we need to report that amount and record it in the books of accounting for 2013. So you need an adjusting entry. There are 2 accounts involved, salary expense, and since we're not going to be paying those salaries until January 3rd, salaries payable is your second account. For 2013, salary expense and salaries payable. You're going to debit salary expense for 400, credit salaries payable for 400, which is the amount that we calculated earlier. To summarize, this is an accrued expense, which means we've incurred the expense. So on the 30th and 31st, we've used up salaries. We've incurred a salary expense. However, we have not paid it yet. We will only pay it on 3rd of January. Because of that, we have to do an adjusting entry to measure our salary expense for the year 2013. And how would you record it? Your adjusting entry is you debit salary expense for 400. That 400 is shown as a debt, which is salary payable. That was an example of accrued expenses. We also have accrued revenues, where we record revenue before we collect the cash, and the amount that we earned will be collected in the following period. Let's take a look at an example for that. On December 1st, 2012, Ryan Bank lent $10,000 to a customer for a period of 3 months. The customer agreed to pay $100 interest per month, payable on the maturity date of 2/28/2013. So Ryan Bank lent $10,000. The interest is $100 per month, and the customer will pay the interest along with the principal on February 28, 2013. December 31st, 2012 is the accounting year end. The question is, what is the adjusting entry? Basically, do we have any entry to record as an adjusting entry for this particular transaction? Let's first look at the transaction that occurred on 1st of December. What is your journal entry? You're going to have two accounts, cash and notes receivable. Remember, notes payable is when the company borrows money. In this case, the company is a bank, the bank lent money. So for the bank, it's kind of like accounts receivable, except it's a note. So it's a notes receivable. Your journal entry is you are going to debit notes receivable and credit cash for the amount of money that you lent. Now we know that the customer agreed to pay $100 of interest per month, but that interest will only be paid on February 28th of the following year, 2013. At our accounting year end, which is December 31st, 2012, have we earned any revenue? Have we earned any interest revenue? It's in the form of interest. Have we earned anything? Well, 1 month has passed, so we would have earned 1 month of interest revenue, which is $100. It's not paid to us yet. It will only be paid on February 28th. However, we have earned it. Therefore, we need to record it as interest revenue for the year of 2012. How do we do that? We do an adjusting entry. The two accounts affected by this transaction are interest revenue and interest receivable. Interest revenue is the revenue we earned by lending the money, but since they haven't paid it, it's called interest receivable, not cash. It doesn't go into cash. It's interest receivable, and interest receivable, if you remember, is an asset. So now, what's your journal entry? You are going to debit interest receivable for $100 and credit interest revenue for $100. That is an example of accrued revenue. Accrued revenue, again, is when we have earned revenue, however, we have not received it. This slide from your PowerPoint summarizes prepaids and accruals, and if you prefer, you could print it out and have it with you while you're studying for your exam or doing your quizzes. You may also want to bring it to class in case you want to refer to it while we do problems in class. To summarize the adjusting process, there are two purposes of the adjusting process. First is to measure income. We need to properly measure revenues and expenses so we can measure income. And then the second purpose is to update our balance sheet accounts, which have not been adjusted because of certain transactions that didn't get recorded. Also, if you notice, every adjusting entry affects at least one revenue or expense account and one asset or liability account.